Okay, so everybody, welcome to the third episode of this option series. Okay, so for those of you who have not attended the first two series, let me just quickly give you a quick run through what we went through in the first two series. The first one actually we went through the first part of the basics of option selling, which is actually selling put options. Okay, so we talk about selling put options, selling put option spreads, right? Those are known as bull put spreads. Okay. And in episode 2, we went through one of my favorite strategy going into the recovery phase of the Trump crisis, right? Which is actually call options, right? How we deal with shorter term call options, longer term call options, all right? And just as I was going through all these episodes, right, of option series, right, guess what happened? The market actually started to change. Okay, so the guys, the important thing here is that wherever you are in your investing journey, right, okay, always make sure that you are constantly adapting to the situation. Okay, all right. So let me just start today's session by sharing my screen. Okay, or can you see my screen over here? If you can, type in the date that's on my screen. If you can see, type in the date that's on my screen. All right, fantastic. Okay, so today is the 22nd already. Okay, so maybe before we start, for those of you who have not watched the first two session, what I would suggest you can do is to go to my YouTube link under live stream. So I'll put it in the chat right now. Okay, and you can watch the latest two episode basically. Okay, more than 1,200, 1,500 of people have rewatched already. So for those of you who have not, this will be the thing to watch after this one. Okay, after this. Watch this one first, because this is live. Alright. Okay, so let me go straight into the content. Okay, so before I start, as usual, standard disclaimer, nothing of what I've said here should be, investment advice or recommendation. Please make sure that everything you do, right, you do your own due diligence, right? Seek your own financial advice if need to. And these are all my independent opinion. Nothing to do with, let's say, any affiliates or any companies that I'm associated with. Okay. The main thing here I want all of you to remember is that what I want to do here is to educate you to be a better investor so that you don't get conned by, okay, not conned, you don't get bullied, okay, by the big whales in the market, right? That they have their ways to bully retail investors. So I want to teach you all the ways to kind of like counteract their behavior and in fact profit and benefit from their behavior. Okay, all right. So let's begin right now. I'm currently actually running a grand lucky draw for those of you who are actually opening an account, right? So a brokerage account with Webull, right? Okay, so this is the link over here, rebrand.ly/IWP Webull. Okay, so this is the link over here. Now, if you are new to Webull and you haven't had an account, I must say right now, actually Webull has a very, very good offer where you get to collect free shares. Okay, just by funding $2,000, you start to get free shares already. Okay, so if you're going to do that, sign up through this link, fund 2,000 Sing dollars. Okay, and at the end of their campaign, which is the end of June, I will do a lucky draw. And the lucky draw is actually, actually it's over here at the back. Okay, so it is the AirPod Pro 2. Okay, the latest one that I'm personally using myself. Right. So yeah, so for those of you who are new to Weibo, this will be additional bonus, right? That you don't get out there when you just open a Weibo account in random, right? Only for those of you who sign up through this link and fund $2,000. Okay, right? So this is my personal lucky draw that I want to give back to all of you who supported me, lah. Okay, now let's go into today's segment, right? So a couple of days ago, right? Okay, I don't know how many of y'all are in my Telegram channel. Okay, how many of y'all here came from my Telegram channel? Okay, type in T in the chat. Okay. Then for those of you, where do you come from? Type in where you come to know about this live stream. Okay. Okay. A lot of you from Telegram, right? Okay. So most of you are already in Telegram. Any one of you not from Telegram, right? Do join the Telegram, because that is where I send in the latest updates, right? Regarding live stream or any thoughts that I have, right? I've been having a lot of thoughts, for example, about UNH, right? About some of the stocks that I'm looking at, right? So for those of you who are not on Telegram, do join the Telegram channel, right? It's a free for all channel right now. Okay, so I put a link in the channel. So what did I talk about a few days ago is that I was doing one of my video for my exclusive membership community, right? Known as SMG, Stock Market Genius. Okay, and I was basically saying that very simple lah. For those of you who watch, right? Okay, can you help everyone out there, right? What did I say in the video? I actually made this video for just the membership at first, but after that I released to everybody, right? And what was my main message? For those of you who watched the video, do you remember what was the main message here? Ah, so for those of you in the Telegram channel, right, you will have gotten a good hint and you'll be ahead the market, right, by more than I think 2 days already. Yeah, right. So Amanda is absolutely right. So I was talking about potentially coming to a pullback, right? And I say that this will help you a lot in the months to come. Why do I say that? Because I think this pullback might last a period, right? Maybe a month or even two, right? And I would not be surprised by it. Why? Because when you look at the recovery, right? Okay, we have had a very straight line recovery for a long time. Okay. And when I was talking about it, we just saw our first kind of mini pullback at the start, and the TA was starting to show a bit of fatigue, right? So RSI is very high, MACD is very high already, stochastic is already high for a long time, and we are starting to see that bankers, investors are kind of retreating from the market. Okay, and very interestingly, the market tends to sorry, let me correct myself. The technical analysis tends to lead the market news. Okay, because this TA actually came out, and I talked about it right before the the news came out, right, from Donald Trump's side, where it's no negative economic news, the bond was going crazy, right? Actually, we were like about 1 to 2 days early. The TA was 1 to 2 days early, Okay, so guys, a lot of times, right, one thing I always tell people is before the news come out about wow supply shock right, or the treasury bills going up I don't know what, right? Okay, the chart can actually tell you a lot of things. So if you just look at the chart and you don't read the news, you can also tell that, hey, it is very likely we're going to see something that is, quite dramatically going to happen, right? But having said that, it's also good to understand the news and understand, okay, why is the market pulling back, right? Now you need to align your technical analysis with the news over here, right? So the news is what? Is that treasury yield is going up like crazy. Basically, the Japan bond market and US bond market is crashing, okay? And that came actually after the Moody's downgraded the US rating, right? And Jerome Powell doesn't seem to want to lower the interest rate, okay? Right? So basically, we're going to have a double whammy whereby the shorter term yield is high, which is controlled by Jerome Powell, and the longer term yield is also very high, right? So that is going to really affect the market. And Pinhu here says it as well, right? That right now we are seeing a VIX that is up by 20 to 20.9. 20.9 actually not very high, no. There has been even higher ones, okay? Right? But it is a sign, right? It is a sign that when VIX are jumping, right, that's when the market is really starting to move over here. Okay? All right. So what is happening right now? In fact, Jamie Dimon, right, which is one of the guys that I really respect, he also said that the market is a bit too complacent on tariff, right? And I mentioned this to my membership about 3, 4 days ago. I said, I absolutely agree with him. Why do I say that? Because before the tariff kick in, right, all the retailers, you think what the retailers did? All the businesses, what they do? They saw that the tariff is going to come, soon already. You know what they did? They basically front loaded all their imports. They imported so much that it crashed the US GDP. Okay, because when you import more than what you export, your GDP goes down. Right? That's the definition of GDP, right? So actually, right now, we are still not seeing the effect of tariff just yet, right? Because they haven't had to increase their prices because they managed to front load all the imports at a similar rate to what they were paying last time. So they haven't had the tariff cost on them, and they don't have to offload that cost to the consumer as well. Okay, so it's very likely in a couple of months later, right, on next month's earnings, or so next quarter earnings, or next month's CPI report or PPI report, we should start to see that the S&P 500 earnings start to have a bit of retracement. I wouldn't say collapse. I think collapse is a very big word, but I would say there will definitely be a bit of pullback as well on that. Okay, so potentially what we can do is, number one, you can think about, okay, do I want to offload some positions? Right, I think that is very, very crucial. The second one is, okay, if I don't want to offload some positions, then can I add more funds to my portfolio? Right, so that is also quite crucial. But if you are not able to add more funds and you say, hey Pete, Warren Buffett tell us that we shouldn't time the market, then what can you do? What else can you do? Okay, so in this current market, what would be the best option strategy to use? Okay, and today I want to share this option strategy that its main goal is for those of you who are interested to generate income, right? When the market is kind of like neutral to bearish. Right now we are definitely in somewhat like a bearish market. Okay, so how many of you all here? Okay, so before I begin, maybe as a pulse check, right? Generally, when you are doing up your portfolio, whenever I do with my student one-on-one, right, I always ask them, do you want to build a portfolio that is for growth, okay, G, Or do you want to build a portfolio that is for income? Okay. So maybe in the chat right now, right, everybody type in, don't need to look at your neighbor, type in for yourself. Are you going for a growth or income portfolio? Okay, type in the chat. What are you, which camp do you belong to? Which camp do you belong to? There's no right or wrong answer. Okay, there's no right or wrong answer. I knew it. There will be some of you who will say both, right? Okay, so let me just force you to say one first. Let me just force you to say one first. Later, I'll share with you why, right? Actually having the idea of both is not such a great idea. It is at the expense of one. That means if you go for income, it will be at the expense of growth. And if you go for growth, it will be at the expense of income. Right? It is like that one. Okay, later I'll show you why. Right. So okay, so I can see that's quite a good mix. That's quite a good mix. I would say quite a lot of you are belonging to the income portfolio, right? So I would love for you guys to learn this technique. Now, for those of you who are in a growth portfolio, then what you can do is to use this in a much more, how should I say, aggressive manner. Okay, so today I will go through two types. One is the standard, right? The standard type of generating income using options. Okay, and the other one is a more aggressive type one. Okay, right. Now, of course, things come with risk. Standard, definitely easier to do, less risk. Aggressive, okay, maybe a bit more risk. So you need to adjust it for your own needs. Okay? All right. Okay, so I will go through the first one first, which is a standard. Now, what is the standard one? The standard one is actually something that many of you might have heard of, right? Is that if you already have stocks in your portfolio, and right now you think that the market is maybe having a slight pullback or maybe staying neutral, going sideways, right? Going like that, or maybe just like that, slightly, what can you do? Yes, Pinhu, absolutely right. The first thing you should be thinking about as a standard protocol, okay, is to look at, can you do a covered call position for the stocks that you're already holding? Okay. Now, how many of y'all here have heard of covered call before? If you had, type in me. Okay. Now, if you have not, then type in no. Right? How many of y'all have heard of covered call before? Okay. How many of you have heard of covered call? Type in me. Those of you who have not, type in no. Okay. Wow. Actually, I'm actually quite surprised. There's a bit more no than I expected, because I thought that this would probably be covered in many option sessions out there already. Okay, but let me just go through this. So what is a covered call, right? Basically, if you look at this chart, very simple. What it is basically saying is that, okay, a covered call is you own, you already own 100 shares of a particular stock, okay? And you say, hey, maybe I I don't want to make too much money out of it, right? So, but I want to get income out of it. How can I do that? Is that you sell a call option on it. Now, how does this work? Very simple. If you have 100 shares, let's say the option strike price, that means you bought the stock at maybe 80, okay? Right? You bought a stock at 80. And now you say, hey, I don't mind selling my stocks at $90. Okay. Maybe 2 weeks from now. Right. So I will sell this out to everybody. Right. And I'll say, okay, $90. Okay. So Pinhu say, check this out for cover call. Don't check this out. Watch my live stream here first. Okay. Right. So you say, hey, I don't mind selling for $90. So what can you do? You can actually go out to the market and say, hey, I want to sell this covered call option for $90. That means you promise the other party that you will sell the share at $90 in a specific time frame. Okay? But by doing that move, by making that promise, you are essentially selling an insurance, right? Think about it. You're promising the other guy, right, that no matter what happens, even if the share price goes up to $1,000, I will sell to you at 90. Wow. So those people who are very bullish about the market, they will say, sure, let me buy this call option from you. Right? So when you're selling an insurance, you will earn a premium. Okay. And that's why this is called a covered call. Why? Because you actually own the 100 shares, okay, to sell the call options. Okay. Now, can you sell the call options to promise to sell shares without 100 stocks or not? Can you do that on the brokerage? Do you think so? Yes or no? Type in the chat. Do you think the brokerage will stop you and say, hey, no, you don't have 100 stocks, so you cannot sell covered call? The brokerage will stop you or not? Okay, so yeah, my question is, can you do it, right? The answer is you can do it. The brokerage will not stop you. Why is that the case? Because the brokerage will consider it as a naked call, correct? All right, it will be naked. So please don't be naked. Wear clothes, okay? Right? Wear whatever clothes that you need. Make sure that it's a covered call option. Okay? Now, this is considered an income strategy. Why? Because in a sideways market, right? Okay, so let's say the share price is here and this is 80, and you say, hey, I don't mind selling at 90. Then the share price move up to 89 and then start coming down. So you don't sell your shares, but you get to earn the premium. consider this versus if you just hold on to the share and don't do anything, right? And in fact, you want the share price to stay at this range so you can sell another covered call and then the share price come down, then the share price move again, you sell another covered call, you come down, right? So at the end of the day, maybe the share price come back to the same price, $80, right? You start at 80, you end off at 80. Now, if you just hold on to the share, you would not have made any money, okay? But by selling the covered call options, you will have made premium 3 times, right? So even though the share price didn't go anywhere, you will still have made some profit. Okay, so this is known as an income strategy for a sideways market. Now, what is the potential risk for this? The potential risk is if, right, you sell a covered call, actually you're not so afraid that the share price goes up too much, You're also afraid that if the share price drop too much, right? If the share price don't stop at 80, drop to 60. Right. So that comes the danger. Now, for those of you who have been following me for a while, right? Can you type in the chat? How do we mitigate this? How do we mitigate this very rapid decline in share price? Right? That wow, Pete, how do I make sure that I buy something at 80, right? It wouldn't like wow, super fast drop to like, $50, $40. How do we do that? What is that ultimate safety net? Pin Hu say buy put. No, 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 not buy put. What is that safety net? Lei Ling say buy more share. Buru say DCA. No, no. BK say what? Back cost spread. No, no, no. Guys, it is not about the strategy. Okay? That's why whatever I teach here, I always say, right, it is very different from what people teach out there. They will teach you, right, one strategy to cover the other strategy, and then this strategy fail, you find another strategy to cover. By the time you cover, right, you already lost so much in premium already. Okay? The way to mitigate this is that number one, is not even about dollar cost averaging, right? Very good. Can we give Karina a big round of applause? Everybody type in the chat. CCC is to buy into good companies. Okay? Your only counter rack, okay? Your only insurance against a rapid falling share price that never recovers is to make sure you buy a good company. Why? Because if you buy a good company, the fundamentals keep going up. There is no way the share price will keep going down. No way, right? Because eventually the share price will follow the value of the company. Okay, so make sure you buy the good businesses. Later, I'll share with you some good businesses, and of course, I'll also share with you some more aggressive ones. Okay, right? So that is the number one risk. Then, of course, the reward is what we want, is to keep premium should the stock stay flat. Okay, so this is the main thing. Now, let me show you how to execute the covered call. Okay, so over here, I'm using the Weibo platform. Okay, so you can see over here. Later, I show you the step by step on the brokerage itself. Okay, but this is just a screenshot first. Right, so this is the mobile app version. Okay, so at the moment when I did this, Baba was at 122.19. Okay, so what I can do is say, hey, I don't mind selling Baba shares, right, at 126. Okay, and I'm going to promise it for a period of time. Okay, so now, guys, can I ask you, can you see from here, right? How many days to expiry is this call option? Are you able to tell from this interface? Can you type the number in the chat? Very good. DK, Paul, Esther. Yes, right. The number is 17. Okay, can you see over here? So Weibo actually straight away put in how many days to expiry in the middle, right? So please look at that before you do any investment. All right. So what I'm doing here is this. I already own, okay, 100 shares of Baba. Let's say I buy now. I buy at 122. Okay. All right. I will be selling a 126 call option. That means I promise someone by 6 June. That means 17 days when I do this. Okay, now it's a bit less. Now it's like 14 days already. Right? I will sell you the Baba shares at 126. Okay? Right? And this promise, I can actually buy it for $3.10. I sell it for $3.10, Right? Okay? So this is how you enter a covered call strategy. Now, before any of you enter a covered call strategy, guys, any trade at all, you do the entry plan, you must also do what plan? Everybody type in the chat. Before you enter a trade, you must already do the exit plan. Fantastic. Can everyone type in the chat? Exit plan. Okay. I know many people out there, and I hope none of you here, okay, belongs to that camp. There are a lot of people out there, right, who think about all the entry scenarios, right, but they never think about the exit scenarios. Okay, which is very dangerous because if you enter into a relationship and you don't know how to get out of it, right, then if it goes south, how? Okay. So in this case, think about, okay, what if the share price stays below 126? Number one. All right. So if the share price stays below 126, then very good. I will keep the share and plus the premium, which is $3.10. Okay. Right. So I'll keep it. Now, if the share price, so let's say this is 122, and I sell a covered call at 126, and the share price shoot up all the way, okay, maybe to 130, okay. Then in this case, what will happen is that the shares will get caught away, right? But it will be caught away at what price? Everybody can type in the chat. It will be caught away at what price, right? Yeah, 126, not 122, okay? 126. Okay, so what is your total profit? Very simple. You take the sell call strike price 126 minus away your original purchase price, which is let's say 122. Okay, right? So that is $4. Now, $4 for option, but in reality, the real money that you'll be receiving is multiplied by 100. So that is $400. Okay, but is that all the profit? What other profit do you have? What other profit do you have? You still have the $3.10, which is the premium over here. Okay. So all in all, right? All in all, you actually make 710, which is on average $7.10 per option. Okay. Right. So essentially, even if the share price goes up to 130, right? Okay. Let's say go up to 130, and you are forced to sell at 130, right? Hey guys, which is a better trade? Which is still a better trade? To sell at 130 or sell 126? See whether you're alert. 126 or 130. Actually, it is about the same. Do you realize if you buy a 122 and sell 130, you will make $8, right? Yes, like what Ping said, very similar, right? But in this case, by selling a call option, I made $7.10. Okay, right? But guys, if the share price drop below 126, let's say it dropped to 124, 125, right? Then which one would be better? 130 or 124? Sorry, 126 or 124, the sell call, 126 or 124. Definitely the sell call, right? Why? Because the sell call, you still gain your $3. Okay. So guys, remember, the premium is for you to keep, right? Regardless the share price go up or down, it is yours. Okay. The share price is fully yours, right? So this is how you execute a standard covered call strategy. The important thing is to remind yourself, right, what is going to happen if the share price goes below and what is going to happen when the share price goes above. Okay. And that's why it is very important to have that 100 shares to back you up. All right. Okay. So when do you want to use covered call? Very simple. Is that you think that the share price will go up, but maybe very slightly. Right. So for example, just now when we talk about 122, then we sell call 126, right? We want the share price to, we allow it to go up a little bit, but just don't go up above the sell call price. Okay. Right. Or best if the share price just keep on going sideways. So this is the best. Okay. And this can help you to generate monthly income. All right. And if you already own the stocks and you say, hey, now that the market is going sideways, I don't want to just sit still and not do anything and not earn any money, then what you can do is you sell covered call. Okay. Now, a few things to take note is that when you sell covered call, generally we want to sell about less than 30 days. Okay, because we want the covered call option to expire as quickly as possible. Right. So do explore the ranges between like let's say 17 days, maybe 14 days and whatnot. Okay. All right. So now at this point in time, let me just go to the Weibo desktop app. All right, to let you have a look. Right. Okay. So maybe guys, you all can type in the chat. Any stocks that you think we can do cover call. any stocks in mind that you think, hey, maybe maybe we can do cover call options. So let's see how many of y'all understand what I meant by it is slightly going down or going sideways. Okay. Okay. So probably you don't want to choose something that is too aggressive, right? That is moving too much. Yeah. Okay. Okay. I saw a lot of you. Let me just choose one that I really like. Okay. So I like Biju's and Janita's suggestion, which is Nvidia. Okay. So let's take a look at Nvidia over here. Now, why do I think Nvidia right now is a very good position, right? Because if you look at the trend, it is kind of like, starting to come down. Starting. Okay. You can see the trend is starting to come down. Right. So what we can do is right now is about 131. Okay, 131. Let's go to options over here. All right. Okay, maybe let me share the whole screen so that you guys can see. Okay, let me share the screen. So let's say Nvidia. Okay, so we are at 131. You can see my mouse, right? My mouse is here. Okay, 131. All right. So guys, let's come back to here. If you are 131, okay, and I say that, hey, we're going to do a sell call, all right? And let's say we're going to do a 15-day sell call, about 2 weeks. Okay, about 2 weeks. What strike price would you want to get? You already bought Nvidia at this moment at 131. Okay, can you type in the chat? What is that strike price you want to do? You want to sell your options. Okay, so some of you say 140. What else? What else? What else? Other than 140, what else? 145. Okay, so seems like I need a longer, I need a longer, I need a longer chat here. Okay, what else? Anything? Okay. Meanwhile, I check if I can increase my font size. Okay. I cannot increase my font size. Okay, so the Weibo guys who are tuned in, please help me to give feedback. Okay, that we need to increase the font size here. Okay, but never mind. Later I can show you all on the app. On the app. Okay. All right. Oh, the Zoom itself can zoom in. Really? Let me see. How? Interesting. I didn't even know that. Okay, never mind, never mind. Audience can zoom in. Okay, okay. Audience can zoom in. Okay, okay. All right. Okay, so what's the size price that you want to choose? 140, 145. What else? What else? Anything else? Choose a proper delta. What delta will you choose, Pinhu? Okay. So for me, guys, very simple one. I will just ask myself this very critical question. Okay, looking at the chart, right? So cannot anyhow just shoot a number. Okay, guys. So very important. Don't just anyhow shoot a number. Okay. So ask yourself, based on what I know about Nvidia, okay, right, that how much it can climb, let's say, in 2 weeks, right? What is a comfortable price that I want to put so that if the share price get caught away, right, I'm happy from here. Okay, right? So in 2 weeks, probably I can put like maybe 10%, 10% plus, right? So about 131, right? I can add another like 10%, then maybe about 140, 44, 45. Yeah, possible. Right? So that's something that you can consider. Of course, if you want to be more aggressive, you can go down to even 140. Right? Now, there is one magic way to choose it is that you can look over here at this column. Okay, this column here, it shows you the volume. Okay, it shows you the volume, and you can see over here that it seems to have more volume at the area of 137 and also 140. Okay, right? So in this case, guys, would you want to choose 137 or 140? Which one do you want to choose? 137 or 140? Just choose one number. 137 or 140? Okay, so Muru choose 140. How about the rest of you? Yeah, 140, right? Okay, so let's choose 140. Yeah. So over here, what I'm going to do is I'm going to do a sell call. Okay. Now, I am assuming at this point in time, I already have the 100 shares. Okay, right? So I'm not going to simulate buying 100 shares already. I'm just going to straight away go into a sell call position. Okay, so Nicole is asking, how come when we do sell put, sell call, there's an unrealized profit and loss? Very simple. So Nicole, and for those of you who are a bit confused, when you sell a call option, right, why there's a profit and loss fluctuating? Very, very simple. Is that the brokerage is constantly assuming if you want to close that position at that point in time. Yeah. Okay. But technically, for a covered call, right, is there one scenario that you will technically lose money on if the sell call get exercised? Never, right? Because you're always selling a call option strike price that's higher. That's right. Okay. So in this case, I'm going to do a sell call here, 140. Okay. Right. And I'm just going to adjust the price, right, to let's say the mid price. Okay, which is about 1355. Okay, so let's assume as 1355 lah. Okay, so we sell a call at 140, we get not 1355, sorry, 3.55. Okay, 3.55. Now let's come back here. Let me erase all this so that it's easier for you all to see. Okay. All right. So just now what we did was we did a sell call. Okay, so we buy it at 131 or 132. Okay, we do a sell call at 140. Okay, and we collected 3.55. All right. So guys, can you all calculate immediately, right? What is the ROI over here? Okay, what is the ROI? So, okay, so let me share screen again. Okay, so what's the ROI? The ROI is very simple. 3.55 divided by your purchase price of the share, 132. Okay, so you're getting 2.6%. 2.6%. For how many days of work? For how many days of work, guys? Right? For 15 days, 15 days, you get 2.6%. So, guys, if you do it for 1 month, it is about 5%. 1 month. Guys, how do you feel about this percentage return? Do you like the ROI over here? Okay. So, whenever you are doing any form of trade, any option strategy or whatnot, right? Always do ask yourself this important thing. What is the ROI? Okay. So can everyone type in the chat, right? In this case, how is the ROI here? 5%. Is it good or not good for you? Just type in the chat. Good or not good. Okay. Sell covered call that is $140. It's not even close, you know. Okay. It's not even like close to the current price. Now it's 132. It's only 140. Okay. Quite a good number of a good number away. Right? Okay. Yeah, it's pretty good, you know. It's pretty good. Even if you get exercise. Okay, so guys, let's say the share price move up just nice lah. Ayah, so unfortunate 141. Okay, right? If it goes up to 141, can anyone tell me what will be your purchase price in this case? Your profit, sorry. Profit. How to calculate profit here? Very simple. Okay, let me take out the calculator again. Firstly, you take your 140 minus away 132 because you will have sold it at 140. What else? What else am I missing here? The premium, $3.55. Okay, that is $11.55. Right. So if $11.55 divided by 132, okay, if the share price really goes up to like 141, 142, okay, you will have still made about 8.75%. Wow, that's bonkers, eh? Okay, that is bonkers. That's why this is why I really like the covered call strategy right now. For those of you who have a lot of shares of good companies right now, you see them retracing a little bit, right? This is where it is exciting times. Okay? All right. So this is the covered call strategy. Okay, guys, any questions about covered call first? Any questions? Okay, and maybe at this time, what I can do is that I can show you all the desktop app for those of you who can't see just now. I know just now, wow, the page was very hard to see. My goodness. But when I do YouTube live stream, I can zoom in. Oh, so maybe that's also the benefit lah. Okay, all right. Okay, so any questions here? No questions. Everyone's good. Okay, so let me share screen. Okay. All right, guys, can y'all see here? Can y'all see? Okay, let me just unshare first. Can y'all see? Are y'all able to see the mobile phone share screen? Can type in yes or no? Yes, right. Can see. Oh yes, okay, can. Let me just share again. Okay, so y'all can see. Okay, so I'm going to demonstrate on the mobile because I know a lot of you are on mobile. You're not using desktop, right? Okay, so I'm going to use mobile here. Okay, so what I can do is go to just now, let's say if we already have Nvidia, NVDA. Okay, all right. And what you can do is go to the bottom, the green button there, press options. Okay, now you will see that immediately the 1 day one is up. So minimize that first. Okay, press the side, minimize that, and you can select the 6th of June one. Okay, the 6th of June one, right? So that's 15 days, right? And then you can scroll down to select what is the strike price you want. Okay, in fact, you can go as low as you want, right? But let's do 140 again, right? We're going to do a sell option. Okay, so over here, please double check that it is a sell. So if it shows as a buy, perhaps, finger too thick or whatever, right? You didn't press the correct button. So just press sell. Okay, you can see over here. Now, always double check the price. So just look on top, right? It shows that right now the price is between 3.4 to 3.45, right? So what I want to do, right, is to drop a little bit. Maybe I'll drop it to like 3.4, go somewhere in the middle, because I want to sell this as quickly as possible. Okay, so I don't want to bargain too much, right? Okay, so yeah, so this is what you can do. In fact, guys, can you all see what is my estimated transaction fee? Can you all see now? What is my estimated transaction fee? It's zero. It's gone. Right? It's zero. Zero. You know why it's zero not? Okay, because now there is a promotion going on for Weibo that if you do trade US options, okay, later I can double check. I think it's like the first month, right? Your US options will have zero commission, right? That's why right now you can see mine has zero commission. Okay, right. So this is something to take note of, right? So when you sell, okay, let me just go down again. Okay, so this is how you can do it. Once you set up already, you can press sell, right? Then they will just confirm with you what are you selling. In fact, they even tell you at the bottom, by doing this, you are agreeing to sell 100 shares of Nvidia at $140 per share on or before 6 June. Okay, so just take note, guys, when you are selling a call option, there is a chance that it will exercise early on if the share price shot up too much. Right? Let's say it shot up to 145, in a few days, then maybe it will just exercise at 140. Okay. But just remember when you go in, think of the exit scenario and think of the entry scenario. The exit scenario actually in this case is even if you get exercise, it's okay because you bought it at 132, you sell it at 140. So what's the problem here? Okay. All right. Okay. So this is how you can use your mobile app to do it. All right. Okay. All right. So for those of you who want to take advantage of the options right now, right, where it is free, okay, right. So this is quite a good time right now. Okay. Now before I go into the more aggressive one, wow, the more kisiao one, okay, right. Maybe I take a pause here first. Any other questions that y'all may have? Okay. All right. Okay. If price goes above our price, do we lose out the difference? In a way, yes. Okay. So that's why it is very important, right, Rosalind, to understand that hey, the market right now must be on a trending down situation. Okay. If it's not trending down, right, then you may not want to do what we just did, right? Because you think if the price is going to continue to shoot up, then don't change it, okay? Right. So let me just reiterate why I think Nvidia, in my opinion, right, I think it's quite a good candidate, okay? It's quite a good candidate for it. Okay, so let me see. Where's my Zoom? Okay. Over here, let me share the screen. Okay. All right. Okay. So you can see over here right now, this is Nvidia. There are many signs pointing towards currently looking at potentially is like a bottoming out position. Okay. So number one, you can see this over here, right? It seems to be bottoming out. Okay. And you can also see this one, the light green over here. Okay. And you can also see this over here. Right. So many things is happening, right? This also on top, this also on top. So it looks like there's a good chance that we will see the price starting to, slowly but surely start coming down over here. Okay. Right. So Rosalind, this is to answer your question, All right. Okay. Let me see. Any other questions? Okay. Any other questions? Let me see. Okay. Alan's asking, can Weibo trade 3350? Okay. 3350 is what? Oh, Meta Planets. Okay. Let me see. Uh, Weibo. Let me think. No, it can't. It can't. But the good news is that it can trade the Meta Planet alternative in the US. Okay, so I don't know whether you guys know you can actually like find OTC. Okay, so there's a Meta Planet OTC. I'm just gonna type the ticker symbol inside. You can go and search for it. MTPLF. Okay, so you can look for this one. Okay. NS, other than volume, is there any other method to choose the strike price? Of course, the easiest way, even if you don't want to choose volume, right, is to choose the strike price that you're comfortable to sell the shares. Yeah. So usually for me, in a short period of time, right, about 2 weeks, I would generally choose roughly about maybe 10%. Because the thing about it, in 10%, if I think the market is supposed to come down, it jumped by 10%, that means I am so wrong in my analysis. But if I think that, I think the market is going to start coming down and it's going to chop, chop, chop sideways, then great. It's going to chop, chop, chop sideways, right? Then I won't be, I shouldn't hit the 10%, in my opinion. Okay. All right. Okay. So BK and I think Karina has a good point. Say, hey, but Pete, Nvidia having earnings on 28 May. What do you think will happen? Right? What if after earnings the share price drop a lot? Okay. Okay. So the thing is this I don't know whether you all have been following Nvidia, right? It's just that the last few earnings okay. For some weird reason, right? The last few earnings when there's earnings, right, the share price drop. Okay. The last few earnings, when the share price come, it dropped. The last three. Right. So I don't know. I believe that sometimes a pattern will continue. Okay. But to me, is this. If I own Nvidia and I think that the earnings coming up and I put a 10% markup, that means the earnings it must jump 10%. Then it will hit my share price. Okay, guys, if you have Nvidia shares and on earnings the share price jump 10%, are you happy or sad, guys? Hey guys, are you all happy or sad? You should be happy. Okay, you should be happy. So never think about scenarios where hey, but P, what if Nvidia jump 50%? Guys, a bit unrealistic, right? So think about when you're investing, right? Wow, in 15 days you can earn 10%. That's very good. That's why I always say covered call is one of the strategy that I think has very limited downside. Very limited downside because all you will lose out is any future profits. long-term future profit, not even near-term. Yeah. Okay. Right. Okay. So Pinhu already has an Nvidia sell call at 135. Wow, he even more aggressive than me. Okay. All right. More aggressive than me. Okay. Kelly asks if the strike is 140 on the expiry date is 140 also. Okay. Will the shares get called away? Now, it won't be like 140 exactly. It might be 140 point something. Right. So if it's just slightly higher, yes, it will get called away. Even if it's like 10 cents higher, it will get called away because it makes sense for the other party to buy it cheaper. Ma. Right? It doesn't make sense for them to not buy it cheaper. La. Okay? Right? Okay? What else? Okay, let's see. Okay. All right. Okay, can I say hi Pete? Currently Weibo cannot do OTC for Singapore. It can I can buy US I can. Like MTLF or MTPLF can. I can buy US. Yeah. US OTC, not Singapore OTC. US OTC. Yeah. Okay. Oh, okay. WO has a good question. Do we look at open interest or volume? Okay, great one. So let me go back to the screen to show you. Okay, so let me share my screen. Okay. So this is wait, okay. All right. Okay. So if you see over here, there's a few things that you will see, right? There's these two things called volume and open interest. Now, generally, I would say they are both okay to use. Why? Because you will notice, you see over here, right? At let's say 133, the core volume is 14K. Then the open interest is 21K, right? But if you look at, let's say when it's a lot lower, right? Let's say at 138, okay? It is 2,000 only. Hey, the open interest is still 21K, Okay. So generally what I would suggest is if you are very conservative, right? Okay, then just go for volume because volume shows you the exact number of transaction that's already being done. Okay. Whereas open interest, you can see that open interest doesn't correlate to volume sometimes, right? Because the open interest just tells you how many people are opening a position, trying to make a transaction, but the transaction hasn't happened yet. Maybe they put a price that is very, very far out. Okay, right. So I will generally go for volume. Volume to me is a stronger indicator because it is much stricter. Yeah, right. So you can see for sell call, some of them can be a lot lesser, but hey, the open interest still the same one. Okay. So this is something to take note of. All right. Okay. All right. Okay. So Henry cannot wait. Henry say AP. What is the aggressive one? Okay. Very good. The aggressive strategy is very simple. Let me go into the aggressive one. Okay. The aggressive strategy is that if you don't have the 100 shares, can you still sell call option? Okay. So guys, can you type in the chat? If I don't have the 100 shares, can I still sell call options? Yes or no? Okay, the answer is yes or no. Not selling naked, please, please, please. Must do something one. Her Yi saying, get kinky. No, 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 no. Not selling naked. We're never gonna sell naked, guys. Please wear clothes. Okay, this is a children segment. Okay, this is not R21 show. This is a decent show. Okay, decent show. Okay. So some of you say buy call. All right. Silver says CFD. All right. Yes, very good. I think some of you got it. All right. Wei Sheng and Muru all got it. Okay. The answer is yes. You can do it, but it's via another strategy called a bear call spread. Okay, a bear call spread. Now, what is a bear call spread? A bear call spread is basically you do a sell call first, right? So over here you do a sell call, but you are kind of afraid that if the share price shoot up like crazy, right, and you don't have a sell call, end up wow, you have to lose a lot of money, right? You have to lose a lot of money. So what do you do? Is that at this segment, you key in another component, which is a buy call, basically to cover the position so that no matter how high the share price goes, right? Okay, your maximum loss will just be in between the sell call strike price and the buy call strike price. Okay, so let me go through slowly. So this is a bear call spread. A bear call spread is a bearish strategy that uses two call options. Okay, so what are the two call options? Number one is definitely a sell call, which is at a lower strike price. Okay, so for example, let's go back to just now the scenario. Let's say I start at 80. I think the share price is going to go up. What I'll do is I will first do a sell call here at $90. But I'm afraid that you'll go up like crazy, right? So what I can do is I can do a buy call at a higher strike price, let's say 100. Okay? I'll do a buy call. Now, guys, in this case, can I ask you, when I do a sell call and then I cover my position, I cover my backside, right? With a buy call at 100, right? What is my maximum loss in this case? What is my max loss? Wow, Boon Ang is super fast. Boon Ang straight away type it in. Okay, NSA 10. No, no, not $10, guys. So remember, every time you do a call option or put option or even a spread, okay, you must multiply whatever you are seeing by 100. Okay, so in this case, yes, the in between here is $10, but because each of them represent 100 shares, yes, you need to add in another two zeros. Okay, so here my max loss is 1,000. So no matter how high the share price go, I will never lose more than $1,000. Okay, right? That is the maximum I'll lose. In fact, guys, can I ask you, will I lose 1,000 or actually what is the exact number I will lose? The exact number I will lose is what? $1,000 minus what? Minus the premium. Very good. The premium that I collect. Okay. So in this case, the premium will be after I sell the call and I buy the call, what amount of money I've left. Okay. So usually when you do a bear call spread, it will be what we call a net credit. That means you will earn a bit of money, right? You will earn a bit of money upfront. So this will be your premium, right? So let's say if the premium is $1, okay, that means it is 100. Then actually you will only maximum lose 900 because the premium is already yours regardless of what happened. Regardless. Okay? Okay, He has a question. What if the price is in the middle somewhere? Later I'll show you what happens if it's in the middle. Okay? Right? So this strategy, why I call it more aggressive, is that you can actually do a lot of it. Because if I ask everyone, hey guys, you must have 100 shares of everything before you can, sell call or whatever, right? Then people will say, hey Pete, but my portfolio only got this amount of stocks. Then how? Then I cannot do your strategy already. Okay. So this is a bit more aggressive. You don't need 100 shares, right? But just take note, because it is a bit more aggressive, right? The reward is also a bit limited here because your risk has been limited, right? Because when you sell call, you have 100 shares to back it. So therefore, they reward you for having the shares. So without the share, your reward will be a bit lesser. Okay? All right. Henry said the full name is called Bear Call Credit Spread. Usually Bear Call is credit. There is no Bear Call debit one, I think. Because the debit one is called Bear Put Spread, I think. Yeah, okay. Right. But don't worry, don't think about all those words. I prefer a credit spread. Okay, I prefer a credit spread. Why? Because a Bear Call spread that is credit is easier to calculate. Okay, so I'll give you an example. Let's go back to the Baba scenario. So let's say in this case, Baba is trading at 122, but I don't have 100 shares already. Okay. But I think, I still think I can still sell call at 126 because I don't think the share price will go above. Okay. So I will do a sell call at 126. Okay. I will collect $3 for it. Okay. But just in case, just in case, the share price go up a lot, right? Okay. I will buy an insurance at 131. Okay. I will buy a buy call at 131 and I'll have to pay $1.77. Okay. So you can see when I sell a call here and I buy a call here, my net credit is take $3 minus 1.77, which is 123. Okay, $1.23. Okay. So my max profit is basically the net credit. Okay. Now in this case, what should be my max loss between 126 to 131? My max loss theoretically is what? Is $5, right? Okay. Which is technically 500. But in this case, it is not 500. It is 377. All right. Why is that the case? Hey, guys. Don't obsess over the name, guys. The name is not important. Even if you get the name correct, you don't know the strategy, you are still lost. Okay. Focus here. The name's not so important one, guys. Okay. So how do we arrive at 377? Yeah, minus the premium. Absolutely right. Okay, so take 500 minus 123, you get 377. So this is the maximum premium that you will get. Maximum loss. Maximum loss. Right? So you can see over here, a bear call spread compared to a standard sell call, the premium is definitely lesser. For sure. For the same duration, for both are 17 days. Okay? But your max loss is a lot lower because if the share price were to shoot up and you don't have the share, you can have unlimited loss. So by having this buy call is to cover the fact that you don't have the 100 shares. Okay? All right. So right now, this is the more aggressive one. Therefore, I want to give you all a bit more rules. Okay? A bit more rules and parameters to invest and trade so that you will be in the safe zone. Okay? So guys, when you are trading spreads, the important thing is what? The important thing is it to chase as high a premium as possible. What's the objective? The main important thing. Can everyone type in the chat? What do you think is the most important thing when you are trading spreads? Is it to go for as much premium as possible? Okay. Right? He say don't kena. Wow, that's a very Singapore language, right? So what does kena mean? Kena means what? You lose money. Lah. Okay. How about the rest of you? What do you think is the main thing to go for? Okay. And I want you to learn from here because this is the difference between a good investor and a bad investor. Okay. Right? Position sizing, yes. But why do you need position sizing? Yes, Irene got it. Safety. Okay, so guys, whenever you are trading spreads, prioritize safety over premium first. Okay, that means you do it in a way that you can sleep soundly at night. All right. So I'm just going to share with you guys my own trading rules. You all can use that as a base and develop your own set of trading rules because every trader that I know, to be very honest, right, all got different rules on because different rules apply to different people depending on whether you can handle it. Okay. So it depends. So for example, Mei Ling asked a great question. He said, do we need to close the trade on maturity or let it expire? It really depends. Okay, so I'm going to share with you my own rules and see whether you apply for yourself. But once again, not investment advice. I'm just sharing it openly. Okay. All right. So number one is that whenever I want to do a spread, trade a spread, right? I want to find that it's at resistance. Okay. So that means if the share price goes like that, like that, like that, like that, right? Okay. I want to trade the spread. I want to set up the spread when the price is closer to the top. Okay. Right. So I want to put the spread somewhere here. Right. I do a sell call, buy call. I want to do a sell call, buy call. Okay. My usual date to expiry is about 40 to 60 days. Very different from my standard sell call. I want to give it more time. All right. I want to give it more time. Now, why, guys, why do I want to give it more time? Why don't I want to do it like, my sell call just now? Faster expire, ma. Okay. Right. Why do I want to give it more time? Okay. Can you type in the chat? Why do I need to give it more time? Okay, some of you are you DM. Buang say cater for volatility. Another DM say for safety. Yes, in a way, it's about that, right? So think about it. When I don't have the 100 shares, right? Okay, or put it the other way. When I have the 100 shares, I am fearless. I don't care whether the share price go up or not. If it goes up, I just sell all my shares. So I don't care whether the share price move a lot in the near term. Okay? But if I'm doing a spread, okay, so let me just erase this first. If I'm doing a spread and in the near term the share price go up so fast, then my whole position gone. Right? Okay, so I want to choose 40 to 60 days to give time, for the price to move. Because sometimes when I do a spread like this, right, longer, 40, 50, 40 days, the share price will go up, and then later you come down. Okay, so long at the end of the day, it ends off below, right? Guys, can I ask you, if the share price at the end of the day, it did go above and then end off below, at this point, do I make a profit or loss? P or L? Can you type in the chat? P or L? Profit or loss? Hey, everybody must type it in. I want to see like 100 plus of you type it in so that you understand what I'm saying. Fantastic. Very good. Okay, the answer is profit. Why? Because it doesn't care the path of the price action. It just cares at the final day, right? Or the day you want to close, where the price is. That's all. Okay, so I want to give it to 60 to 40 to 60 days. Now, why do I give such a wide gap, right? 40 to 60 days is because it depends on the premium. Okay, so this is where you need to use the premium to guide yourself to decide, the time to expiry, which one to choose. Okay, and usually I want to go for what I call a 1:5 profit and loss. Okay, now, what does this mean? For example, just now I did the example of 126 to 131. Okay, so in this case, my maximum loss is $5. So a 1:5 loss means I must at least make how much, everybody? My premium collected must be at least how much? Must be at least $1. One. Okay? I must at least make one. Now, why do I want 1:5 minimum? Is because when you're putting your trade quite far away, okay? Quite far away, there is about a 70 to 80% chance that you will not get hit. So for that, I need to be at least compensated by $1. Okay? Statistics. Okay? Right? So just now, actually, in fact, just now that trade, even though it's 17 days, right? Actually, it already fulfilled my criteria already. Because just now that one is a 1:3, And in fact, I seldom see this kind of 1:3 one for such a short duration, right? I seldom see one. Usually very short duration like this, right? Okay, I will tend to see like a bit like maybe 1:6, 1:5, right? Okay, so right now the situation is quite unique. Even when you choose lesser days, right? Okay, you still can get 1:5, but I will still want to stick to at least about 40 days. Okay, now you will see why later on because this is the entry rule. Everybody type in the chat. After you do the entry, before you go to the Weibo app and start typing like crazy, anyhow key in order. Okay, don't do that. What should you do first? After you discuss the entry strategy, what must you do? Everyone type in the chat. Discuss what strategy. Yes, very good. Plan for the exit, plan first. Plan for the exit before you enter. Okay? Plan for it before you enter. Okay, so let's look at exit. So what's the exit rule? Very simple. Go through the two scenarios again. If the market price is above the spread, that means let's say if I do 125, 131 here, and the share price goes like boom above, okay? Right? Sorry. Market price is above. Sorry, I correct myself. If the market price is above, actually it should be below. Sorry. Let me cancel this. Below, above. Okay? Because when you do a back call spread, you want the share price to stay below, Okay? So if the share price move up and then come down, right? Then very simple. Don't do anything. Just let it expire. Go until the last day expire. Finish. Okay? But if the share price is okay, I'm going to cover this like crazy so you cannot see. Okay? But if the share price is if the share price went shooting, boom, like that. Okay? Now, guys, what do you do? Very simple. If it shot up above and you're already at the 20-day mark, okay? So let's say you bought something for 40 days and it burn until like 20 days. Okay? I will immediately do the cut loss. And if I still want to enter the trade, I will enter another spread at a later date. And this is called a roll. Okay? Right? So maybe here I will take a bit of a loss and then I'll lick my wounds. Okay? Then I'll move on. Why do I want to accept this? Is because, guys, when you trade a spread at a very far away from the current price, there's maybe a 70 to 80% chance of success. But guys, what does 70 to 80% mean? Does 70% to 80% success means every time success? Yes or no? Type in the chat. What do you think? No, 70% to 80% chance of success means for every 100 trades you do, there will be 20 trades that doesn't go your way. Okay? So guys, if you have a trade that doesn't go your way, is it absolutely normal? Is it expected? Is it within your expectations? Yes. Okay. But what you need to do as a good trader is to say, I acknowledge this trade. I totally got it wrong. I thought the share price is going to stay below, but it went above. So I will immediately what? Everybody type in the chat. Cut loss. Okay. So this is the toughest part when you're doing spreads because a lot of people, when they see the trade do south, what do they do? What do? They put their hands together and start to hope for the best. Okay, guys, hope is not a strategy. Okay, hope is not a plan. So yes, like what Nicole say, cut loss, write a trade journal on what went wrong for the trade, right? So if it's share price went above already, went above, and it's less than 20 days, what should you do? Just cut loss first, and if you want, you can roll it. But if you don't want, just cut loss first. Take it as this is one of the failure, the 30% failure out of your 100%. Okay? But if the share price is still above, but I still have more than 20 days, maybe I'm at 30 days to expiry. What I'll do is I'll leave it. I'll be patient. Why? Because there might be a chance that the share price can come down. And in fact, even if I hold on a little bit more, the share price is already above my this spread, right? Does my max loss change? Will the max loss increase if I hold on to it for a little bit longer? Yes or no? Guys, can you type in the chat? Does my maximum loss increase even if I hold on to it a little bit longer? Yeah, it doesn't. Okay. So I will just cut it. Okay, I will just leave it. Maybe let it come down. So hopefully by the time it haven't hit 20 days to expiry, it will come back down. Okay? Right? So yes, Boktek has a great comment. He says, so the stock have to be on a bear trend. Yes. That's why, come back here, I will always do it on the resistance. That means even if it's not on the bear trend, it's fine. Right? But let's say the trend is like that. This is the resistance. This is the support, right? Correct or not? I will want to do it when it's closer to the top. Because after I do the spread, actually what I want is I want the share price to come down. Okay? All right, fantastic. Okay. Okay. Eleanor has a question. She asks, why 20 days not considered enough time to recover? The thing is, when I look at a lot of the statistics paper that's being done on trading, they actually suggest the 20 days as a cut loss mark because after 20 days, the spread actually starts to lose value very, very quickly. Right? That means your sell call part will lose very, very fast. Your buy call part also lose very, very fast. So end up, the chance of success is very low, right? Okay, so these 20 days, to be very honest, is not something that I have come out from nowhere one. It's like I go and read all the statistics, right? And they say it's about 20 days. That's where the best chance of success there is. Because take note, at 20 days, when it's above, it doesn't mean if you sell, you will incur the maximum loss. It does not mean that. You may have only lost like maybe 50% of your maximum loss, right? You still can recuperate 50%. So the idea is this when you're trading, guys. So this is a mantra that you all must understand. As traders, you want to win big. Okay, that means when you win, you want to win big. But when you lose, you want to what? What must you do when you want to lose? You want to lose small. Okay? You want to lose as little as possible. So don't wait for the time decay to catch up for you. Right? So at the 20-day mark, if you can, just stop it already. All right. So yeah, correct. So it will reach max loss very quickly if you continue in the wrong direction. Absolutely right, BK. Okay. So at the 20-day mark, statistically, you have the highest odds of salvaging any losses, any capital, right? And if you hold on the trade beyond 20 days, I'm not saying you cannot, but it's just that from my stats that I've been reading and also my personal trading experience, if the price is already quite high and still left only 20 days, right, there is very little chance of it coming back on. Because it's very likely what happens is that your initial understanding of the price trend is already wrong. Okay? It's already wrong. Yeah. So a good trader knows that when he's wrong, you must what? Everybody type in the chat. A good trader, when you know he is when he or she know he's wrong, yes, Carlos. Emotionlessly, kapak. Okay, Carlos. Okay, Wei Sheng asks, what if someone exercise early, then it drops? Okay, usually 20 days haven't exercised yet. Very unlikely. Okay, spreads usually don't get exercised so soon. If you tell me 3 days left, maybe lah. Okay, yeah. Okay, but if it does happen, very simple. If your sell call get exercise, all right, what you can do is straight away go and close the whole position. That means you buy back the 100 shares, right, and then you sell the buy call away. Yeah. Okay. Okay, so when to do a buy call spread is that you expect the share price to stay below your sell call strike price, which is a short strike, we call it. Okay, this is ideal for once again neutral or slightly bearish outlook. Okay, slightly bearish outlook. The good thing about buy call spread is that even if you small account, you don't have a lot of shares, right? You can also do, right? So this is quite a good method for those of you who want to get started to practice a bit of trading. At least you know that okay, this is my max loss, right? Let's say you do a spread of $5, right? You know that my maximum loss is $500. Even if you don't follow any of my rules, let's say you don't follow any rules, 20 days you still hold on, whatever, okay? You never do on resistance, you totally do it wrong. Your max loss is $500. So it is a very good way to train your trading instincts. Okay. But do take note, always position size. Don't go and do too many until your whole portfolio all back cost spread. Then it will expire in 20 days. You know, that kind of thing. Very risky. All right. So use a smaller portion of your portfolio to kind of trade, right? To get a hang of it before you decide whether this is for you. Okay. So let me reiterate the risk and reward summary for both. When I do a back call spread, the good thing is that there is a clearly defined risk and a clearly defined reward. How much premium I'm getting, how much money I'm losing. Okay, right? But just take note, you need the price to stay below the short strike. Otherwise, there you will incur the loss, right? The spread loss. Okay. Whereas cover call, actually, you think about it, right? Now that we go through bear call and cover call, actually it's quite different. Bear call is not so much about worrying about risk or reward. It's just that you want to earn premium on the stocks that you already own, right? So that in a way, you are kind of exchanging the upside, right, for premium. So just now when I asked a lot of you, hey, do you all want growth or you want income? And some of you say I want both, right? I hope that now you can understand why you cannot have both, right? Because let's say if you have Nvidia share price now at 131, right? Okay. And you do a sell call at let's say 140, okay? Or 145, like 145, right? If the share price stays below, good, you get premium. Okay. But if the share price goes above let's say to 155, then you will not earn the difference here. You will still have to sell it at 145. So that's why when you are selling call options, in a way, you are exchanging potential profit if the share price goes up, right? For income. That's why income, right? The premium here, the income versus the growth, a lot of times, right, when you're doing options, right, is exclusively mutually exclusive one. Okay, so guys, you understand what I'm saying now or not? Okay, so for those of you who say, AP, I want to absolutely go for growth, then actually you may not want to do covered call that often. Or in fact, if you want to do covered call, right, you should not do very close. Maybe you should do a 155. All right. But guys, can I ask you, if you own a share at 131, but you go and sell call at 155 instead of 145, what happens to the premium? Can you type in the chat? What happens to the premium? The premium will drop. The premium will drop a lot. Yes. Okay. So let me show you all over here. Okay. Let me share the whole screen. All right. Okay, let me go in. Okay, so you can see I'm back here to Nvidia, right? This is one day, maybe I do this 15 days again. Okay. So you can see just now I choose the 140 140. Right. So 140, if I zoom, I scroll down, okay, I can sell about 3.6. Can you see that? 140, I can do 3.6. But if I push it up to 155, hey, suddenly my premium drop to 0.8, no? So from 3.6 drop all the way to 0.8. So your premium effectively got cut by about, I don't know, how many percent is that? Right? You lose close to like $2 plus, right? So there is quite a big difference here. Right. So just take note. If you want to be a bit safer, when you sell call, of course you can sell very far away like this, but the further you sell, then the lesser premium you make. Okay, so it should be educated number lah. Okay, so you should say, okay, I think how much can Nvidia jump 133? I let you jump 10% now. Okay, maybe I let you jump until 145 lor, so something like that, right? Then that's where you calculate where you want to sell call. Okay, to be very frank, some people always say, oh, we go with delta. Delta must be 0.2. Yes, you can do that. If you go 0.2, then it will be about 148. But I prefer to look at it in a way that, okay, what is the price that I'm willing to sell my shares in, let's say, 2 weeks' time, in this case. Okay, right? So this is what I would prefer to do. Okay. Okay, very good. All right. Okay, so now we just passed the 1 hour already. I want to transit into the Q&A segment. Okay, so guys, any questions? All right. Okay. Okay. If no questions, what I want to do now is this. I know some of you are also messaging me, ask about the Weibo rewards. What's the Weibo rewards? Okay. So let me just show the Weibo rewards again. Okay. So right now, when you sign up for Weibo, here is the QR code and the link over here. Okay. You can receive up to 600 shares of Apple shares. Okay. But I would say 600 is if you really fund a lot. Okay. If you fund like, I think 100K or something like that. Okay. So the realistic one, is actually the 10K. Okay, let me show you over here. What's the 10K one? Okay, so over here, if you fund 10K, right, you can already get 300 shares already. Okay. So this one, maybe don't tell the Weibo guys. I tell you all. Okay, but I think they're here. Okay, but never mind. Okay, so if you want to go for the best ROI one, right, actually, is the 10K one. Because if you divide 60, divide by 2K, and divide by 300, divide by 10K, actually, this is the same as the 2K one. But if you got 10K, then you fund it. So when you fund this, I think you do 5 trades, right? You will already get 300 US dollars of shares, Apple shares. Yeah. Okay. And Apple is one of my favorite company also. That's why I love it also. Okay. Joseph, is it only for new users? Yes, this is only for new users. But for existing user, they also have a transfer in bonus. Okay, so I don't have the details here, but you can go to Weibo website and check. If you transfer in like I think 50K of shares or something like that, right? You also get something. I believe if you transfer in like 200K of stocks, you get an iPhone, Yeah, so for those of you who are existing shareholder, existing Weibo user, you can do that. Okay? But for those of you who are new, right? The good thing is this. Right now, okay, US stocks, they got 0 commission for 31 days. All right. US options, they got 0 platform fee until further notice. Okay, so this one, I don't know how long it will be. So for those of you who do options a lot like me, right now Weibo has one of the lowest options fee that I know of. Okay, I will not say who I will compare to, not very polite, but when I compare to the rest that I know I use, Weibo is currently the cheapest. Okay, right? And for those of you who want to even trade Singapore shares, the good news is that they also have zero commission for up to 1 year. Okay, so for now, all right. Now, for those of you who sign up for Weibo during this period, right? Other than the Apple AirPod Pro here that you can get, you can see over here the US dollars, US stocks, they say zero commission for 31 days, right? Okay. If you use my link for today, actually they got give a special bonus for my community, right? You will be able to double your zero commission up to 60 days instead of 30 days. So that's something special that they give to all of you. Okay. All right. Joseph asks, can non-Singaporeans sign up for Weibo? I think you can. I think Malaysians, all these all can try. Give it a try. If cannot, then do let me know. Give me feedback. I'll let Weibo side know also. Okay. So this is just a standard disclaimer, right? Just to show you all. But one thing I like about Weibo is they are a license holder, lah, right? So I feel quite safe. I have quite a lot of money inside also. Okay. Right. Okay. So this is only for those who are new and sign up the account during this webinar. All right. So I already put the link in the chat. Let me just put it in again. Okay. For those of you who are new, you want to sign up, this is the current bonus. And remember, please fund at least 2K, then you can enter the lucky draw for this, right? I will ask Weibo to help me give me the numbers and the name to do lucky draw for this. Okay? All right. This one is about, I think, $300, 300 plus, right? So actually, in fact, you already got the bonus, right? The max bonus of the 100K, right? Because if you get $300 here and then you still win the airport, you get 600 plus, right? Okay? All right. Okay. So that's all I wanted to share with you all in terms of strategy. Now, one thing that I want to show you all right now, right? I don't know whether you are aware. Just now, I think one of you asked about, okay, any question about the Weibo offer first? Or not? Yes or no? If you don't have, then I talk about the thing that just now someone asked. Any questions about Weibo offer? No, okay, no, then I just leave it here first. Okay, so just now, I think some of you asked me about Meta Planet. Okay, so guys, so this one is the additional part. Okay, do you know what is Meta Planet? What is this stock that got everyone so excited recently? Okay. So recently, why these stocks went bananas is because they are actually Bitcoin related stocks. Okay. So I don't know, guys, whether you all know Bitcoin. Okay. So maybe let me share. Bitcoin right now has gone up to quite a high level. Okay. Let me show you here. Okay. Right. So Bitcoin now is about 111K. 111K. Quite a lot. Quite a lot. Not joking one. Okay. So actually one of my more aggressive strategy, right? Okay, so this one, guys, uh, I just say maybe if you want to try out, you want to practice, okay, do it on paper trade first. Okay, do your paper trade first. But I show you some of the trades that I've been doing and showing my SMG community, right? Already passed already, but I think I can show you. Okay, is that if you are bullish about Bitcoin, okay, and let's say you got some Bitcoin ETF called IBIT, okay, you all know Bitcoin ETF is IBIT, don't know, okay, let me type in the chat, it's called IBIT, okay, I show you all using the mobile app easier, okay, let me share the screen here, okay, all right, so let me bring up Weibo, okay, so you can actually own Bitcoin through IBIT, which is the Bitcoin ETF, okay, so let's assume you are bullish on Bitcoin. Okay, you already have IBIT shares, for example, right? Okay, and let's say you have 100 IBIT shares, which is actually not very expensive. IBIT right now is $63. So 100 shares is what? Is 6,003, okay? Right? What you can do if you go to options, okay, and you just look at maybe 15 days, okay, and you do sell call. Okay, so let's say you don't know whether Bitcoin is reliable or not. You don't know how much more it will go because right now very high already. Okay. And you guess that hey, maybe it will start to drop. Okay. So maybe what you can do is you can sell very close to at the money. Right. So what you can do is now the share price is 63 something something, right? Okay. You can sell at about 68. Now you can sell at 68. How much do you get? You get about $1. Okay. You sell a call option, you can get about $1. Okay, so guys, when you sell at $1, okay, what is your ROI here? So $1 divided by 68, okay, so we calculate together, 1 divided by 68. okay, is 1.4%, right? In 15 days, right? That is if the share price don't go your way, That means you don't think it's a good company, okay? Right? So this is the more aggressive one that I like to do right now. Because if I already have IBIT shares, I say, hey, why don't I get the volatility to my side? I get some money out of it. Okay? Right? So that's one way to look at it. Okay? If you think 15 days, like 15 days like very little day. Okay? You want to be more lazy one. What I usually do is I just do lazy one. I just do 29 days. Right? I do 29 days and then now it's 163, right? Let's say I buy 100 shares now. Okay, lor. I do 66. I should collect $2. $2 means what? $2.35 over here. 235. Right? So what is 235? Let's see. 235 divide by sorry, what is that? 60 66. But right now my share price what? 60, okay, 66 lah, can. Okay? 3.5%. Right? So guys, this is though for those of you with Bitcoin, right? Okay, this is something that I'm personally doing right now. Is that I'm selling a bit of call options here and there when Bitcoin has gone up so much. Because will it continue to go up? The thing is, I don't know, right? So I will take part of my Bitcoin, right, to sell that call option to gain premium. If it goes sideways, great, I collect the premium. If it shoot up, great, I managed to sell my Bitcoin. I was going to sell some of my Bitcoin because it's so high already. I want to take profit, right? Then I do it. Ah, okay. So this is some of the ways that I'm using sell call right now. Even though, to be very honest, I think the share price is coming down. Okay. Kenneth asked, can we do DCA on Weibo? Yes, the answer is yes. Okay. So let me double check. Okay. So let me show you on the app. You can. Okay, so maybe Kenneth, can you tell me what do you want to DCA on? Then I show you. What do you want DCA on? Mark is asking, would it be better to sell IBIT put? Let me ask you, Bitcoin now is like that. You want to sell put? It's very high. Usually when it's high, I want to sell call. Okay, I don't want to sell put. I want to sell put when it's what? At support. Okay, not at resistance. Okay, the other way around. Okay, so Kenneth is asking about IBIT. You want to do DCA on IBIT? Okay, can. Okay, I show you. Okay, so you go back to the chart here, right? Okay, you can do trade. Okay, so let's say you want to buy, I don't know how much you want to buy now. Let's say you want to buy 100 shares. Okay, you want to buy 100 shares, right? So you can either just buy, right? Okay, like that, you can just buy. Or what you can do is, I sent the order already. Okay, never mind, just buy. It's okay. Okay, so, right? What you can do is you can actually go to the RSP. Okay, so what is RSP? RSP is their regular savings plan. So if you scroll down here, right, you go to shortcuts here, you go to more. Okay, you scroll down. Can you see under trading there is a RSP? Okay, click on that. Okay, you can select the symbol you want. IBIT. Okay, so if you like IBIT, you select IBIT. Okay, you can choose however much you want to invest. You can choose $10, you can choose $100, up to you. Okay, so this is when they buy a fixed amount on a frequency. So the frequency you can set like every week, every 2 weeks, every month, or even every trading day. Okay, why they say trading day is because weekend they don't trade. So they will buy 5 times a week. It's up to you, right? And then you can choose when you want to do it. Let's say you want to do every week, they will ask you which day you want to start. If you do every day, then there's no day to choose. Okay? But the cool thing is this. Over here, right, you can also link it to your bank account, So you don't need to proactively fund the account. They can deduct straight away from your brokerage, also your bank account. Okay? Now, the cool thing I want to show you is the dynamic here. Okay, so what you can do is you can do dynamic investment. That means it's not just, let's say, $100 per week, right? It's based on how the share price move. So over here, you can see if the share price move up too much, right, it will buy lesser percent of what you said. So for example, over here, it says between 6 to 10%, it will buy 70%. The multiplier is 70%. That means, let's say, if you put $100, it will buy $70 instead of $100. Why is that? Because the dynamic recurring investment is basically thinking that if the share price goes up too much, actually is not a good sign. I don't want to pay so much, so I buy less. Okay, but the minimum percentage you will buy is still 50%, half of what you said. Okay, But in the other direction, if the share price drop, right, this is where I think this Weibo thing is quite cool. You can DCA in a more smart way. Because if you just keep DCAing the same amount as the price drop, right, actually you're not investing more, right? But if the share price, let's say, drop by more than 15% over here, as you DCA, it will actually help you to invest more, 200% of what you set. Okay, so if I set 100, it will actually do 200, right? So if you're comfortable with that, then you can go to dynamic and you can set, okay, you know, every week, Monday, okay, I will buy this amount. The benchmark can be the stock itself, or you can even benchmark against the index. So that means if the index drop by 15%, you buy two times more. But if the index go up by 20%, you buy less. Right. Then you can also benchmark against like is it moving average or whatever. But usually I just leave it to 120 and I just choose the symbol itself. Okay. So this is quite a cool feature that I don't see in other brokerages. That means this is like a smart DCA. It buy less when the share price go up, it buys more when the share price go down, which makes sense, right? Because when you are investing, you want to buy more when the share price go down, right? That is called value investing, right? Okay. All right. Okay. Okay. Any questions? Um, Katie asked. Okay. So I think I can